Good morning, everyone. I'm Amy Smaller, Senior Director of Healthcare Education and Professional Development at the Massachusetts Health and Hospital Association, and I want to welcome you to today's webinar, Determining Employee Retention Credit Eligibility for Healthcare Organizations, Facts and Misconceptions. A few logistics before we start. If you have any questions, please place them into the chat feature as we are in listen-only mode, and we will do our best to address all the questions as they will come directly to us today. I also want to take a moment to thank MHA's 2025 annual sponsors, as well as our strategic partners for their support in underwriting today's webinar, which is just one of many events that we offer throughout the year to connect our members with leading experts to help address timely issues like the one today. I'm pleased to introduce our speakers from Sagemont Tax, who are additional sponsors for today's webinar. We have Tori Beck, who is General Counsel, as well as Kenny Detman, who is a CEO and Managing Director leading Sagemont Tax. Thank you both for being here today, and welcome to our program.
Thanks for having us.
Thanks, Amy.
I think we'll start with a quick introduction of ourselves. Tori, you want to get started?
Sure. So my name's Tori Beck. I'm General Counsel here at the firm. I was a practicing attorney. I was a litigator for about 10 years, and then I decided to come in-house and work with these folks at Sagemont, and I've been focusing on the partial suspension portion of the ERC for about 2 years now. We'll get into that in a little bit, but it is the legal analysis that we'll be looking at today.
Thanks, Tori. And I'm Kenny Detman. I'm the CEO, Managing Director, and founder of Sagemont Tax. Sagemont Tax is a specialty tax practice that focuses exclusively on tax credits and incentives. We've helped over 3,500 organizations claim the employee retention credit. About 50% of those organizations are in healthcare. So we have extensive background in both healthcare, and I'm also pleased to say that many of the healthcare organizations and other businesses that we've helped are situated in Massachusetts. While I am a licensed CPA in the state of Florida, a fun fact about myself is that I married into a Massachusetts family and spend about half of my year on Cape Cod. So I am very integrated into Massachusetts, and as a result, we ended up working with a lot of Massachusetts-based clients. For the first decade and a half of my career, I was a partner at Alvarez & Marsal. Alvarez & Marsal is a global professional services firm of over 10,000 employees today. While I was at Alvarez, I co-led their global tax function for 2 years. And during COVID, I founded their ERC task force. And I led all things ERC at Alvarez for 2 years. In late 2021, decided to leave and start my own practice, which is now Sagemont Tax. And yeah, for the last it's been 5 years, I've been almost exclusively focused on the employee retention credit. So for about as long as anybody can be involved with the employee retention credit, I have, I'm towards the top of that list. So next, we're going to walk you through just a brief agenda. If we could flip the slide. So we're going to start and try to go relatively quickly through the 101. And then we're going to jump right into eligibility misconceptions in healthcare. There's a lot of things we want to call out in this presentation to get you guys thinking about whether it makes sense to start looking at this, considering where we are with the timeline. You'll learn very quickly here that the ERC effectively expires on April 15th. So we've got less than 2 months to consider whether there's an eligibility case and whether to pursue this study. We'll give you a quick ERC case study of an organization that we worked with that is primarily based in Massachusetts, has hospital operations. This organization, many of you are probably familiar with, is Primacare. And then we're going to talk through what to look out for in an ERC advisor. We're also going to talk briefly about why the tides have shifted a bit in the ERC world. Many of you have, I'm sure, been warned that there's rampant fraud is a term that the IRS used a while back. There's certainly a way to do the ERC right, and there's certainly a way to do it in a way that is aggressive and potentially infringes on fraud. We're going to explain to you what to look out for in an advisor, and ultimately what decision-making process should be involved with deciding to actually pursue and file for the employer retention credit. On to the next slide, please. So we'll jump into a brief 101. For those who are relatively familiar with the program, it existed for both 2020 and 2021. The 2020 credits effectively expired on April 15th of 2024. So we're now just looking at the 2021 credit. The 2021 credit was largely only is largely available to employers that are under 500 full-time employees. So we'll get into that full-time employee test and make sure that we're all thinking about that the right way. The 2020 credit, I'm going to guess that most of the folks on this organization are above 100 full-time employees. But the 2020 credit was really only available in large part to employers under 100 full-time employees. The total distribution of the available credit when it was sort of in full force, it was up to $26,000 of available credit. 5,000 of that lived in 2020, 21,000 of that lives in 2021. So the most substantial part of the credit anyway is available in 2021. And in order to maximize the 21,000, you would have to be eligible for all 3 quarters. Many organizations we work with are only available for 1 or 2 quarters. So we're certainly not maximizing the credit for all of our clients. And in order to get to that $7,000 per employee mark, an employee has to have earned $10,000 or more in either wages or employer paid health care. So if somebody is earning less than $10,000, it doesn't mean that they're not eligible for credit. It just means they're eligible for 70% of that amount in the respective quarter. Next slide, please. So the most controversial part of the employee retention credit is eligibility. How can an organization be eligible for the credit? Well, it's one of 2 ways. One is a bright line accounting-based revenue test. It looks for a 20% quarter-over-quarter drop in total gross receipts across an organization. Most healthcare organizations that we're working with have faced 2 payer increases since 2019. They also experienced probably significant increases in demands in some of the services that they're providing and decreases in other services. But by and large, most organizations that we're working with did not experience a decline in gross receipts. Fortunately, Congress envisioned that there were scenarios where an organization's gross receipts weren't impacted, but the organization was still impacted by virtue of COVID-19 executive orders, hence the creation of what's called the Fuller Partial Suspension of Business Operations test. We've shortened that to just partial suspension here, as every hospital in the country was not fully shut down. So we look to a subset of this test, the partial suspension test, which asks the question, was an organization affected in its ability to provide goods or perform services, in your case, perform services, due to COVID-19 executive orders? I think we universally know the answer to that question is yes. However, we do need to meet certain threshold tests that the IRS created. Tori will get to those tests in a bit more detail. But question 1 is, was your organization subject to a governmental order? Massachusetts Department of Health had executive orders that spanned way past the eligibility period, September 30th of 2021. Were there changes, were there restrictions or modifications that were made? And as a result of those, were they sufficient enough to rise to the level of meeting what the IRS defined as a partial suspension? Tori won't steal your thunder. I think we're getting into that into a bit more detail in the next slide. So let's move to the next slide, and Tori will really get into the meat of partial suspension.
Okay, great. So this is the way that our firm approaches the partial suspension test based on what's written in the statute, as well as guidance that's been issued by the IRS as to how we should be approaching this analysis. So the first step that we take is we look at your operations generally, and we see how we can break them down into different portions or segments or departments. So for example, for a hospital, that could be the emergency department, surgeries. It could even be broken down into OBGYN, primary care, that sort of thing. So we'll look at that, and we want to determine if one of those segments comprised at least 10% of your revenue or employee service hours in each quarter of 2019. 2019 sort of being your pre-COVID baseline operations. If we can determine that, then we can show that that segment that we're looking at that experienced an impact was a more than nominal segment. That's the way they define it. So from there, we're going to look at what government orders were in place. Kenny mentioned that the Massachusetts Department of Health had orders. Also, there were executive orders in Massachusetts that were issued by the governor during 2021 that affected all businesses, but also specifically healthcare and healthcare providers. So we're going to be looking at those and making sure that the mandates that were in there, such as social distancing, enhanced cleaning and sanitization requirements, were really big for healthcare organizations, of course, and that the adherence to those mandates resulted in an impact to your ability to provide services. So then once we determine that we have those orders in place, we're going to look at the changes that you specifically made to your operations in your organization to comply with those. So we're going to get into this a little bit more in the next slide, just to give you some examples and kind of get your wheels turning and think back. I know this was kind of a long time ago at this point, but just to remember what you were doing at that point to make sure that you were adhering to those mandates, the social distancing, the extra cleaning. And then from there, sorry, I'll pop up here. And then the last step is we kind of bring it all home. We look at the impacts that you experienced, and we want to make sure that the impacts, that there was a more than nominal impact to your organization, to the segment that we're focusing on. And by that, we're going to look at a KPI that makes sense for your organization and for the segment that we're looking at, that really demonstrates that you had that 10% impact. Typically with healthcare providers, we're going to be looking at patient encounters or the number of patients seen. And we're going to be looking at each 2021 quarter and then compare it back to that corresponding quarter in 2019 to show that you had a 10% reduction in those patient encounters due to your adherence to the orders. Can we see the next slide? Thank you. So as I mentioned before, these are some examples of changes in operations that we've seen in a lot of our healthcare clients that we've worked with. So since we're when it comes to hospitals, a lot of times with their emergency department, there were major changes made to the way that triage occurred, or, patients were coming to the emergency department. So, we want to talk about whether, patients were, had to do COVID screenings outside. Sometimes hospitals even sent out or created like an outside triage area with tents. Sometimes they had patients waiting in their cars and calling in and filling out paperwork in their cars so that there wasn't patients gathered in the waiting areas because of social distancing mandates. So that's a major one. Another one is turnover time between patients. So because of all the enhanced cleaning and sanitization that was required, it often took more time between patients. So, sometimes 10 minutes, 15 minutes, but that added up over the day. So it resulted in fewer patients that they were able to see in one day as compared to pre-pandemic normal operations. Sometimes patient spaces where there were multiple beds or chairs had to be reconfigured so that you could accommodate that 6 feet of social distance that was required. Elective procedures. This was more in 2020, but I believe in the beginning of 2021 in Massachusetts, there were some restrictions on elective procedures and reserving PPE for COVID patients and that sort of thing. So just elective procedures, surgical procedures generally. Also, that turnover time I mentioned before, turnover time between surgeries is also something that came into play because of the enhanced sanitization. Can we see that?
One thing that, Tori, I see often is the reconfiguration or the reduction in number of beds in pre-op and post-op, which naturally reduces the number of procedures that can take place. So it's another one to be on the lookout for.
So now I think we're going to talk about some misconceptions when it comes to the ERC and healthcare providers.
So I mentioned earlier a 500 employee, full-time employee threshold. It's not to say that if you're greater than 500 employees, you can't still access the credit, but the credit is extremely limited, particularly in 2021. You're only able to take the credit on wages paid to employees while they're not performing services. Those types of wages really didn't exist in large part in 2021. So what we're looking for is trying to fit an organization at this point into the definition of a small employer for the 2021 credit. And so in evaluating full-time employee, it's important to point out that the IRS is looking for us to apply the same rules that we apply for the Affordable Care Act and testing employees. And the Affordable Care Act looks to whether an employee was working more or less than 130 hours per month. And it's a 1 or a 0 test. There's no such thing as a full-time employee equivalent for these rules. So we've worked with a number of organizations. Primacare is actually a good example. Primacare had, from a full-time employee and employee equivalent standpoint, had somewhere around 600 or 700 full-time employees and full-time employee equivalents. However, because we are only looking at the 1s and 0s, those that were greater than 130 hours in a respective month, when we looked at the full-time employee of Primacare, they ended up being 450 employees. So one easy place to look for your full-time employee account is your Affordable Care Act reporting. Also, we're referring back to 2019 for testing size. We're not looking at 2020 or 2021. So if you increased headcount over COVID, that may be okay if you cross that threshold. So I just want to make sure that the organizations on this call understand that if you're somewhere in your head between, say, 500 and 1,000 employees, you got to think part-time, full-time employee equivalent. You really want to ensure that you haven't overlooked this small employer credit by deeming yourself out by saying, well, we're too big, we have 600 employees. It does need to drill down into that full-time employee and not employee equivalent test. The second misconception is our organization took, whether it's PPP or non-PPP funding, you can still access the credit. Many of you would have been too large for a round 2 PPP, which is when you would have taken the SBA forgivable loans in 2021. If you did take the PPP, that's okay. We just have to make sure we don't double dip on those wages. When it comes to non-PPP governmental assistance, most of you probably took the Provider Relief Fund and other medical related grants. It's important to remember that those are not, under the ERC rules, treated as double dipped. And so there's nothing within the ERC legislation that says you need to take into account double dipping on governmental grants. And then from the perspective of the provider of those grants, HHS, IRSA, they explicitly came out and said that ERC does not constitute other assistance, i.e. it's not a reimbursement of payroll, and therefore it doesn't necessarily negate the ability to take ERC. And just as an overarching concept, the employee retention credit is not meant to be thought of as some type of revenue replacement program. It's not even a reimbursement of wages. It is a credit that's purely calculated based on the amount of wages paid. So it's a refundable payroll tax credit. It's not reimbursement of wages. It's a credit that's the baseline for calculating the credit is wages. And I would encourage you that if you do decide to explore the employee retention credit, you're going to want to make sure you work with a provider who's highly knowledgeable about these types of grants and the interactions. Next slide. Tori, you want to jump on this one?
Sure. Oftentimes we hear that healthcare facilities believe that they don't qualify for the ERC because they didn't have that decline in gross receipts. But as Kenny mentioned earlier in the presentation, there are the 2 ways to qualify. And oftentimes for healthcare providers and health centers and hospitals, we see that they don't qualify under that significant decline in gross receipts test, but rather under the full or partial suspension test that I mentioned before, that legal analysis, the government orders test. You don't need to satisfy both of the tests to qualify, just one is sufficient. And I will note that the full or partial suspension test is very nuanced and very specialized. And so you really want to be working with a provider that has a lot of experience with this test and really a deep understanding of what needs to go into qualifying. You want to make sure you're working with somebody who finds those metrics for you, like I mentioned before, those KPIs, and just that more than nominal portion and more than nominal effect to support your eligibility.
Slide, please.
So this is another thing we often hear is that our facility was never fully shut down. I think there's a misconception that you needed to have experienced a full shutdown of operations. You know, you were ordered by the government to be closed in order to qualify for the test, and that's not the case. You know, as we've been referring to it, it's the full or partial suspension of operations test, and to qualify for that partial suspension, even if your full operations were continued to operate as normal, even with during COVID, because you were an essential business, the partial suspension of operations test really just requires you to show that because of the modifications you had to make to your operations to comply with the orders, you experienced an impact in your ability to provide those services. So again, that's going to be that more than nominal portion, and a more than nominal effect to a more than nominal portion of your operations was impacted or restricted because of your adherence to the orders.
And I just want to remind that the IRS, not Congress, not the statute, chose this concept of a more than nominal portion or a more than nominal effect. And so, you know, while the ERC could have you know, while the IRS could have, within the ERC guidance, used words like significant when it comes to partial suspension, they didn't. They chose a relatively low threshold. That threshold, more than nominal, was offered a safe harbor of 10% in terms of measuring both, do I have a more than nominal portion and a more than nominal effect? So we're not necessarily looking for significant impact. We are looking for something that rises just above insignificant. And, you know, where in the world was more COVID safe and potentially more COVID impacted than a hospital or medical organization? Next slide, please. There we go.
So, okay, so this is another thing we often hear is that healthcare organizations think that they don't qualify because they're an instrumentality of the government. But there was actually a revision to the Consolidated Appropriations Act of 2021 that created a carve out for organizations whose principal purpose was to provide medical or hospital care. I believe everyone on this call probably meets that obligation or that requirement. So that carve out makes it available to you, even if you are a government in an instrumentality of the government.
And also, just to layer into this, nonprofit organizations that are not government instrumentalities are very clearly eligible for the employee retention credit. So that didn't require a carve out. The original rule said for profit or nonprofit.
Yeah, that's right. I think a question just came up about nonprofits, actually. And if we could see the next slide, I think we address nonprofits directly here.
There we go. I jumped the gun. I'm sorry, Tori.
That's okay. No, that's right. So nonprofits can qualify, like Kenny said, the same way as, you know, traditional business can, a restaurant or, you know, a daycare center, let's say. It's either that they have to meet that significant decline in gross receipts test or the full or partial suspension test. So there's no restriction on nonprofits being eligible for the ERC.
Perfect. Now I think we're going to walk through a case study of Primacare, like I mentioned.
Okay, yes, so Primacare. So Primacare is a Massachusetts-based healthcare provider. We worked with them closely. We found eligibility for them in the amount of $11.4 million. So their FTE count was 452 full-time employees. I believe Kenny touched on this a little bit earlier. They qualified under the partial suspension test. So we focused on, as their more than nominal portion was the outpatient and urgent care segment of their operations. It represented 52% of their revenue in 2019. So that's well above the 10% requirement. So that met the more than nominal portion test. From there, we looked at their patient encounters in their outpatient and urgent care segment, and they experienced a reduction between 11% and 18% for all from Q1 through Q3 of 2021 compared to those corresponding quarters in 2019. So they were found to be an eligible employer for all 3 quarters of all available 3 quarters of ERC in 2021.
And also important to point out that Primacare has successfully received 100% of those funds, including interest. And I just want to flip back to, we talked about the 2 percentages, 52% of revenue, 11 to 18% of patient encounters. The more than nominal test does not require a 10% decline across the entire organization. It allows us to break the organization up into smaller pieces as long as those pieces represent greater than 10% of service hours and revenues. Then we sort of latch on to where was the most impacted. There might be more than one that was meaningfully impacted, and we get to evaluate those on a standalone basis. And under the rules and the guidance, we're actually able to ignore what happened with the rest of the organization. The rest of the organization could have more than made up for the patient drops or the revenue drops within these affected portions we're looking at. And that's exactly what we did with Primacare. We identified where do we have more than nominal portions, where was the most impact. In this case, it did happen to be in the outpatient facilities. Primacare does have inpatient hospital facilities as well. They were impacted, but the most prominent of the impact was felt in the outpatient and urgent care. Okay, now I'm going to take you through what to look for in an ERC advisor. So there's been a lot of warnings from the IRS about this concept of an ERC mill. So it might be helpful to describe, well, what is an ERC mill? What is the IRS warning me about? And by and large, an ERC mill is an organization that is not led by accountants or attorneys. It's typically led, in most cases, we see them led by serial entrepreneurs that were, doing something non-tax or accountant related, saw this big opportunity in the employer retention credit space, and decided to largely develop a sales and marketing organization to convince as many businesses as possible that they would be eligible for the employer retention credit. They'd go out and maybe hire a token attorney or an accountant to greenwash, if you will, the work that they were doing. But these organizations were not accountant or lawyer-led. Sales and marketing, the most substantial part of the organization was that sales and marketing function, TV advertising, radio advertising, and very little attention towards the actual function of accounting and legal part of this. Our job as an ERC provider is to put you in a position where if the IRS were to examine you, that you could be immediately responsive to a request from the IRS. We already know what the IRS is asking for under examination. It's the same stuff the IRS told us that we needed to possess and document as part of a study when they released guidance around the employer retention credit. So our job is to be able to produce a supporting file that's not sent to the IRS, but literally sits in our files and your files, so that the IRS ever asks questions, we're immediately prepared to be able to respond to those questions. The other thing that distinguishes perhaps an ERC mill from a Sagemont Advisors or another organization that's sort of on the right side of providing ERC services is deep experience in tax, accounting, legal, preceding the provision of the ERC services, that also have experience working with the IRS, working through audits, understanding the nuances of regulatory versus sub-regulatory guidance. So I would encourage that if you do end up looking at the employee retention credit again, make sure to work with a firm that has deep credentials in tax, has experienced lawyers and accountants that lead the organization, and that can work collaboratively with your C-suite and your advisors, because you all have some auditor that's ultimately going to look at this. We have deep experience working with the Big Four, working with top 200 accounting firms that are responsible for auditing your organizations and getting both obviously the C-suite, the board of directors, and your outside advisors comfortable with the claim. And if they're not comfortable with the claim, we don't move forward with the claim. So we can be all the way on the eve of actually making the claim. If there's a level of discomfort within the organization, there's no obligation to pay us fees. There's also no obligation, of course, to move forward with the claim. Next slide, please. So again, what makes us a little different? Like I said, I've been working in the employee retention credit space as long as anyone could possibly be working there. I sign every single amended payroll tax return that leaves our office, which means I'm taking responsibility and putting my professional license on the line related to every ERC tax position that we take. We work with some of the top attorneys, external attorneys in the country on the employee retention credit. DLA Piper is a firm that we have worked alongside for the last 3+ years. They have helped us and help both develop and evaluated our process around, in particular, partial suspension. Every file that we produce, again, we need to produce substantiation that's directly responsive to what the IRS requires. Therefore, we're not only putting the tax and accounting support, we're putting the legal and the qualitative and quantitative analysis behind partial suspension. In terms of timeline, we're running out of time. April 15th is the last date that we can submit. Actually, I believe it might be April 19th in some cases. We are less than 2 months away from that deadline. So it's important, if you want to take another look at this, if you want to take a look at a study you've already done, you're probably going to want to make that decision quickly, because we're limited to less than 2 months. We can turn around files relatively quickly. We have a robust team. It typically takes us 15 to 30 days to turn around a file by the time a client signs our engagement letter. And then audit support. We're at zero cost to you before you've actually even paid us $1. If you've decided to opt for a fully deferred plan, we will support you through an IRS examination with professionals that have experience with both ERC audits and non-ERC audits. To date, we've had several audits. We have several in process, less than I can count on 2 hands. We've had 0 unfavorable adjustments under IRS examinations, which means the IRS has agreed with our eligibility positions 100% of the time. And just for your knowledge about process around audit, the IRS is examining ERC claims before checks are leaving the IRS. This is incredibly important, because this effectively means that your ERC eligibility, if it's going to be looked at by the IRS, will happen before those checks are in your bank accounts, which means that you're in some ways insulated from penalties and interest, provided you are putting forth a reasonable eligibility position. So the IRS is not sending out checks and like they did with the PPP and figuring it out later. They're actually withholding the checks, examining clients, and then once the examinations are concluded, and if the IRS does agree with the underlying eligibility position and calculations, at that point in time, checks would be released. Next slide, please. So some of you may have already claimed the employee retention credit. Perhaps you claimed it in 2020. Perhaps you claimed it all the way through the end of 2021. Sagemont Tax is available to review your prior claim to ensure that, if possible, you've maximized the credit. So Tori mentioned a minute ago that, and you guys know this better than us, but the Massachusetts Department of Health had mandatory orders in place through all of 2021. So all of the 3 quarters of eligibility. We want to make sure that you maximize your eligibility, that you took into account all of the available quarters. We also want to make sure that your calculations were accurate. Some providers and some CPAs took a very simplistic approach with respect to PPP or with government grants. They basically blacked out all of those wages and said, you can't take any of these wages inside, say, a PPP covered period. that doesn't comport to what the guidance within the IRS rules allow us to do, which is we're still allowed to look within a 24-week covered period and allocate between PPP and ERC. We want to make sure, again, not just governmental orders, but that through the partial suspension test, we're properly looking at these two more than nominal portion tests and evaluating them and applying them in the appropriate way. And then probably not overly applicable here, but there is the concept of aggregated employers. So if you have related parties, whether through ownership or through common management control, it's important to understand whether entities are required or not required to be aggregated. This is mostly important for the 500 employee test. When organizations start having to combine with one another, it often sends them above that 500 employee limit. Our job is to evaluate and make sure that the appropriate conclusions were made with respect to aggregating or not aggregating. We'll jump into Q&A in a second. I want to spend just a second here talking about sort of the why now. Some of you have probably heard, oh, ERC died, or ERC has come back to life. Neither of those are true. The ERC has not changed since really the end of 2021. There's been some additional guidance that's been provided. What has changed is the IRS put a moratorium on ERC processing on September 14th of 2023. Went almost an entire year without seeing any credits processed. The IRS has since moved that moratorium to January 31st, 2024, which means that a claim submitted today technically falls within that moratorium period. It's our belief, and this belief is not just based on our opinion. It's based on conversations we're having with Congress. It's based on messaging that we're hearing from the Internal Revenue Service and potentially their new leadership. This moratorium will be lifted. There was also a real threat twice of the ERC program being retroactively terminated. What we're hearing from Congress today is that's no longer a real possibility. There is still a possibility that Congress does end up repealing or retroacting the ability to claim within the third quarter of 2021, but a blanket repeal across all of 2021 does not appear to still be on the table. Even if you do decide to work with us, and that does happen, that would be unfortunate. But because we offer a fee structure that allows us to fully defer your fee until you're paid, there is obviously a way to hedge against that. And I mentioned this moratorium of processing. The IRS has been meaningfully processing ERCs now since August of 2024. So we have seen meaningful processing. We have seen the IRS move on from this narrative around widespread fraud. I think the intent of the moratorium was largely to slow down the inflow of very aggressive ERC claims. I think the IRS was successful at actually accomplishing this objective. So we do praise the IRS and the approach that they took to slow down the processing. But now we've got 2 months left to give this a second look. Like I mentioned, IRS is evaluating these claims under examination before checks are cut, so does mitigate the risk of interest and penalties from that standpoint. So if you are interested in learning more in evaluating this at no cost, at really no risk, we are here, we're available, and we have extensive experience again with both medical organizations. I think, Tori, at this point, over 1,000 medical or medical related organizations we've worked with, and also have a unique perspective into Massachusetts in particular, based on certainly my local presence there for half of the year, and the great clients that we've worked with and the referrals that they've sent us, within Massachusetts. So from there, I think we're happy to hang on and answer any questions that anyone has. Feel free to put them in the chat. We'll hang on for a few minutes here and not,
Yes,
we can close
and
up.
thank you both. There have been a couple questions that were answered during the conversation, which is always great. And I've actually gotten some private notes of folks saying you've answered the questions that they had coming in. So the presentation has been fantastic, with all of these notes.
Wonderful.
And yes, this is recorded, and all of the slides will be sent out because there are a lot of resources and information. So again, thank you so much for having it so clear and well presented, in the sense that, in bite sizes, so people are understanding. There is a question here. How can the IRS be processing claims if there's still a moratorium?
So the moratorium is relevant to claims that were submitted after the moratorium date. And so that moratorium date used to be September 14th, 2023, which meant that claims submitted prior to September 14th, 2023 were not under a moratorium. Now, we really didn't see the IRS act on those filings over the course of about a year. That moratorium date's now been moved to January 31st, 2024. And so the claims that are being worked today are claims that were submitted on or prior to January 31st, 2024, which means the moratorium as it exists today applies to claims from February 1st forward. There's no expectation, the IRS has communicated, there's no expectation to indefinitely keep that moratorium. We expect the moratorium in full will be lifted by April 15th, 2025. There's no reason for them to keep the moratorium once the filing window has closed.
Great. Yeah, thank you for that. I'll leave one more moment. Like I said, there have been a lot of great questions, and this presentation has been very full of information. So I know our members are really grateful for both of you.
It's been very confusing over the last, at least several years. This program has garnered a lot of certainly attention, and it's just extremely important to make sure that you're working with licensed, credentialed, and experienced professionals to insulate your organizations against risk, but to also take part in a program that was very clearly designed for organizations that, despite all of the curveballs that COVID threw us, that still managed to prevail, didn't necessarily experience a decline in gross receipts, and continued to pay and maintain their employees.
Well, great. And as you can see in the comments, this is
Course.
is exactly, I think, what folks need to do. And again, thank you both, Tori and Kenny, for being here today. And on behalf of MHA, we're happy to bring events like these ones to you all. And just a note for next week, we actually have our Joint Commission annual update. That's a virtual event for next week as well. And we continue again to be supporting events in 2025, and we hope you all have a great rest of your day.
Thank you. Thank you
Thanks,
so much
Amy.
for having us, Amy. Take care, guys.